Everybody thinks the housing market is just cooling off. But what if I told you it's actually entering into a brand new, really dangerous phase that could quietly drain your wealth, spike your costs, and trap you in place? By the end of this video, you'll understand why home prices are dropping in nearly 1/3 of all major cities, why hidden costs like home insurance pushing homeowners into crisis, and why that big pile of home equity might not be as safe as you think. Hi everybody and welcome back. I'm here to break down exactly what's happening in the housing market right now. No sugarcoating. This is one of the most significant shifts we've seen in years. And whether you're thinking about buying or selling or just staying put, this affects you. So let's get into it. According to CNBC, nearly 1/3 of the largest 100 US metro areas are now seeing year-over-year price declines of at least 1%. Nationwide, annual home price growth has slowed to just 1.3% as of June, which is the weakest pace we've seen in 2 years. Inventory has jumped a massive 29%, meaning more homes are sitting on the market and taking a lot longer to sell. Andy Walden, Vice President of Enterprise Research at ICE, put it bluntly: increasing inventory levels are helping to make homes more affordable, but prices are falling in an increasing number of markets and homes are taking longer to sell. Some of the biggest drops are happening in places like Cape Coral, Florida, where prices have fallen at least 9%, as well as Austin and Tampa, which were hot pandemic boomtowns. Meanwhile, the Midwest and Northeast have been more stable, but even those areas could see changes if economic pressures continue. Mark Zandi, the chief economist at Moody's Analytics, recently called the housing market a red flare for the entire U.S. economy. According to Zandi, with mortgage rates hovering near 7%, housing is about to become a major drag on overall economic growth unless rates drop soon, which he says seems unlikely. Builders are already responding. They're cutting prices, offering bigger incentives, and delaying new land purchases. Goldman Sachs is now forecasting essentially zero price growth nationwide in 2025 and expect declines of more than 5% in markets like Miami, Orlando, Nashville, and Dallas. So what does this mean? It means if you're a buyer, you might finally see more options and less intense bidding wars. But at the same time, higher interest rates keep those monthly payments high. And if you're a seller, you might be staring at longer days on the market and potential price cuts. Now let's talk about something that isn't grabbing enough headlines: home insurance costs. From 2022 to 2024, insurance premiums jumped 20% nationwide, and they're projected to climb another 8% this year. While that might sound like a small percentage, it translates to thousands of unexpected dollars out of pocket. MarketWatch highlighted one striking example. A California homeowner on the state's FAIR plan saw his insurance premium spike from $7,000 to $12,000 in a simple year. He told reporters they can't buy homes because they can't afford the insurance. These surging costs are starting to push some homeowners into mortgage delinquency, especially FHA borrowers who tend to have tighter budgets. The national mortgage delinquency rate climbed to 3.2% in May, a notable jump. Alana McCargo, president of Ginnie Mae, explained that these sudden cost spikes are creating what she calls payment shocks, similar to what we saw in the 2008 financial crisis. But this time, driver isn't risky loans, it's insurance and maintenance costs that keep rising. Despite these challenges, American homeowners are sitting on record amounts of home equity, over $35 trillion in total. Nearly 47.7% of mortgage holders have at least 50% equity in their homes. That sounds great, right? But here's the problem. This leads to what's called the lock-in effect. Homeowners with ultra-low mortgages from a few years ago feel stuck. Selling now would mean giving up that 3% rate and jumping into a new loan at 7%. So instead of moving, they stay put, which further constrains inventory and keeps markets tight, even as buyer demand drops. Meanwhile, first-time home buyers are having an even tougher time. According to Fortune, about 20% of Gen Z and millennial buyers are now relying on family gifts for down payments. Another 20% are selling investments like stocks, and around 12% are even cashing out crypto savings. The result? An even wider wealth gap. The median net worth for homeowners is about $430,000, while for renters, it's just about $10,000. This disparity is one of the biggest reasons housing remains so emotionally charged. It's not just about a roof over your head. It's about long-term financial security. So where do we go from here? First, mortgage rates are not expected to drop significantly unless we see major economic weakness or inflation suddenly coming under control. This means affordability will stay tough. Second, inventory will likely keep rising as more homeowners eventually decide they can't wait forever, especially if insurance costs and maintenance bills keep going up. But more inventory doesn't always mean more affordable housing. If buyers remain priced out by high rates, prices could stagnate or even drop further. Third, homeowners may start tapping into their equity through home equity loans or cash out refinances to cover unexpected costs or renovate instead of moving. But higher borrowing rates make this less attractive and more financially risky. Finally, we're still seeing a real shift in where people want to live. Some of the pandemic's hottest markets are correcting quickly, while the Midwest and Northeast may continue to look more stable, at least for now. So to sum it up, the U.S. housing market is no longer just cooling. It's facing multiple headwinds at once. Falling prices in key cities, hidden cost shocks like skyrocketing home insurance, and an equity trap that's keeping homeowners stuck. If you're thinking about buying or selling, the most important thing you can do is stay informed, budget conservatively, and look beyond the headline price tags. Think carefully about the hidden costs and risks before making a big move. Where I am here in the DC housing market, which includes Washington, DC and its suburbs of Maryland and Virginia, we're seeing a crazy, mixed, very confusing housing market. Some houses are selling in multiple offers. I've had 3 out of the last 4 transactions. Multiple offers, while others are sitting on the market getting price reductions week after week. I've seen those as well. The difference though that I'm seeing now, even with the multiple offers, is we're seeing a lot more home inspections, appraisal contingencies. It does feel a little bit more balanced. You can negotiate on your buyer's behalf. And that, in my opinion, is a good thing. But it is very, very confusing. Add to that all the economic uncertainty here in the DC area, with what's happening with the federal government and layoffs and other policies, there's a lot of anxiety in the air. So if you are thinking of buying or selling here in the DMV, want to know what's happening in your neighborhood, please feel free to reach out to me. Send me an email, send me a text. We'll talk about it because every neighborhood is different. Every house within the neighborhood is different. It's very, very confusing. And quite honestly, very unsettling. Because when people don't know what's gonna happen, they freeze. I'm gonna keep making videos about what's happening in the housing market, so please stay tuned, subscribe to the channel, let me know what you really wanna hear, because I wanna do that for you guys. There's a lot going on out there. Some of it is kind of scary. So let me help you out. Let me be your reporter. I'm happy to do that. Thanks for watching. I do appreciate it. Bye.